All right, let's dive right into it. Today, we are unpacking V2X, trading under the ticker VVX. Now, you might have seen the splashy, jaw-dropping headlines recently about their massive new Pentagon contract, but look, as expert investors, we know we have to look past the hype, right? We need to see what's actually under the hood. So, today, we are putting V2X through the absolute ultimate gauntlet. We're going to evaluate their economic moat through a Warren Buffett lens, stress test their margin of safety like Benjamin Graham would, and then really ground ourselves in the quantitative reality of their cash flows to see if a discounted cash flow valuation holds up. Okay, let's dive into this.
Here is our quick roadmap for today's explainer. First, we'll cover that massive defense contract. Second, their mission and technology. Third, we'll tear into the income statement. Fourth, we'll scrutinize the balance sheet and cash flow. And finally, we'll weigh the strengths and risks. Rest assured, we are going to cover the massive narrative first, and then methodically unpack the financial reality underneath it all. So kicking things off with Section 1, the $15 billion defense contract. Yeah, your eyes aren't playing tricks on you. That is $151 billion with a B. V2X recently locked down a highly pivotal position under the Missile Defense Agency's SHIELD contract. SHIELD stands for Scalable Homeland Innovative Enterprise Layer Defense. Basically, it's a program hyper-focused on next-generation, multi-layered missile defense modernization, protecting the country against everything from hypersonic weapons to complex drone swarms. However, and this is absolutely critical to understand, this $151 billion is a ceiling. It is the maximum cumulative value of all task orders that can be awarded to all participating contractors over the entire life of the program. So it's not a direct $151 billion check cut to V2X today, but rather it's a central pillar of the Pentagon's long-term strategy. Through a Warren Buffett lens, this creates a massive economic moat. It's a durable, highly regulated ecosystem where V2X has secured a very competitive seat at the table. As Jeremy Winsinger, the CEO of V2X, put it, the SHIELD IDIQ aligns directly with the work V2X is already performing to protect the nation. From supporting cornerstone sensor and missile defense programs to enabling integrated defense operations worldwide, our teams deliver proven results every day. And this brilliantly illustrates exactly how V2X is positioning itself within America's national security infrastructure. They aren't some new, unproven player. They already possess deep, embedded expertise with legacy systems, like the Cobra Dane early warning radars. If we're thinking in Peter Lynch's terms here, they are positioning themselves not just as a risky, unproven fast grower, but really as an institutional stalwart that is cleverly leveraging an existing footprint to capture future growth. Moving right along to Section 2, V2X's mission and technology. Because, look, before we crack open the ledger, we really need to understand what V2X actually builds. They describe themselves as a leading provider of global mission solutions integrating physical and digital environments. Basically, they are a key player in transforming how defense acquisition actually works. You know, the old way of building defense systems was incredibly slow. It relied on these massive, isolated, single pieces of hardware. The new way, the SHIELD way, prioritizes speed, rapid scalability, and this intelligent network that seamlessly connects sensors, command and control systems, and interceptors to function as one cohesive whole. And to neutralize sophisticated threats like hypersonic missiles or drone swarms, you need absolutely incredible technology. V2X's core tech focus is right where you'd expect it to be. They are leaning heavily into advanced analytics, artificial intelligence, and machine learning just to make sense of the absolute tidal wave of data coming from global sensors. They utilize digital engineering and rapid prototyping to essentially build and test software in virtual environments long before it ever hits field deployment, which drastically cuts down development time. And naturally, cybersecurity is absolutely paramount because a networked, highly connected defense system is a prime target for cyber attacks. Ultimately, these aren't just fancy Silicon Valley buzzwords. This is the literal proprietary tech stack that will drive their future free cash flows. Let's move to Section 3 and see how this builds into the income statement. Now, what's really interesting about this slide is the story of pure efficiency. Look at the revenue growth from fiscal year 2024 to 2025. It's a fairly modest 3.7%, bringing them up to $4.5 billion. But look further down the board. Gross profit jumped 8.9%. And net income? Net income skyrocketed by 124.5%, jumping from $34.7 million to $77.9 million. How exactly do you pull off a 124% profit jump with only 3.7% more revenue? Leaner overhead discipline. Benjamin Graham absolutely loved to see this kind of earnings stability and operational efficiency in his defensive investor checklist. V2X is essentially proving they can double their net income through strict fixed cost absorption, rather than just relying on explosive, unpredictable top-line sales. But to really grasp the true quality of these earnings, we need to utilize a metric called the Piotrowski F-score. If you aren't familiar with it, this is a phenomenal 0 to 9 scale that evaluates 9 distinct binary signals across a company's profitability, its leverage, and its operating efficiency. It's an incredibly robust tool for stripping away the noise and separating fundamentally strong companies from weak ones based strictly on hard accounting. And get this, based on their fiscal year 2025 data, V2X scores a flawless, perfect 9 out of 9 on the Piotrowski F-score. Literally every single box is checked. All 4 profitability signals pass, including positive income and positive cash flow. All 3 leverage and liquidity signals pass, and both operating efficiency signals pass. Furthermore, their earnings quality is considered to be heavily cash-backed, with a ratio of 2.34x. What that means in plain English is that for every single dollar of reported net income, they're actually generating $2.34 in real operating cash flow. Their profits are supported by cold, hard cash, not just clever accounting adjustments. If you're building a DCF valuation model right now, this incredibly reliable conversion to operating cash flow makes projecting your future terminal value significantly more secure. But, as always, we can't just look at the income. Let's pivot to Section 4, Balance Sheet and Cash Flow. Because while the income statement is glowing, their overall health scores suggest the foundation has a few cracks we need to talk about. Take the Altman Z-score, for instance. This metric predicts the likelihood of bankruptcy, and right now, V2X sits at 2.51. That puts them squarely in the gray zone, which falls between 1.81 and 2.99. It tells us that despite that completely perfect Piotrowski score we just saw, there are structural elements on the balance sheet dragging down their overall financial health. For a strict disciple of Benjamin Graham, this moderate financial risk immediately starts eating into your margin of safety, and it definitely warrants some strict monitoring moving forward. Looking at cash conversion, the company obviously remains highly cash generative. In FY25, they generated $170.1 million in free cash flow against that $77.9 million in net income. However, we have to note that that free cash flow actually dropped from $242.4 million the prior year. So while they still convert earnings to cash very efficiently, mostly due to fairly light reinvestment needs, it appears that working capital is absorbing a good chunk of the gain from their earnings rebound. Put into Warren Buffett's terminology, their true owner earnings are currently slightly constrained by these reinvestment and capital needs. Let's put this all into a really clear side-by-side comparison. On the strength side, we have that fantastic leaner overhead discipline. We have a solid $100 million share buyback program, which shows management has serious confidence. And they boast a conservative debt-to-equity ratio of 1.00. But look over at the risks. Their current ratio is really tight at 1.22, giving them an abysmal liquidity score of just 19 out of 100. That could severely limit their flexibility if cash inflows were to suddenly slow down. But most importantly, and this is a big one, they have $1.68 billion in goodwill just sitting on the balance sheet, which actually exceeds their $1.08 billion in total equity. Peter Lynch always warned investors to look for strong, tangible balance sheets. Because V2X is a heavily acquisition-built company, their reported leverage looks a whole lot better on paper than it actually does in tangible asset backing. Which brings us to our final takeaway, Section 5, Weighing Strengths and Risks. Let's bring all these threads together. So the crucial point is this. Is the massive $151 billion Shield contract ceiling enough to outpace this heavy acquisition-built balance sheet? The Buffett moat is clearly present. The Piotrowski score is completely flawless, providing highly projectable, stable cash flows if you're running a DCF model. But Graham's required margin of safety is absolutely being squeezed by that tight liquidity, and Peter Lynch would for sure raise a very skeptical eyebrow at that massive pile of goodwill. For a strict value investor, this might just be a hold until the balance sheet becomes a bit more tangible. But for a growth-oriented investor banking on massive defense modernization, it is undeniably a compelling watch. So does the strategic potential outweigh the paper leverage? That is the question you have to answer. And that wraps up our explainer for today. Keep learning, stay focused, and we will see you next time.